In this video, I'm going to share with you the 4 financial risks that most retirees fail to see. And I'm going to give you concrete solutions on how to protect yourself from these 4 risks. My name is Matthew Copley with Copley Financial Group, and I'm here to help you maximize your income and minimize your taxes. What I see is a lot of financial clients that come into the office and they're hyper-focused on one type of risk, and that is stock market risk. Now, I would agree that now in today's environment, stock market risk is definitely elevated. When you look at the data, when you look at all of the things out there like the CAPE ratio being at elevated levels, you look at the high valuations in the market, yes, stock market risk is something we definitely want to focus in on and identify and make sure we're protecting our clients from a potential big drop in the stock market. But just hyper-focusing on just that one risk is a huge mistake. There are many other risks that retirees need to look at when designing a financial plan and looking at their big financial picture. And 4 of those risks are big risks that people oftentimes just ignore. The number 1 risk is interest rate risk. This is a risk that if interest rates go up, the value of a lot of their fixed income investments go down. Now, we saw this in 2022. Interest rates spiked up. We saw huge drops, double-digit percentage drops in their bond portfolios, in their fixed income portfolios. And when you're in retirement, you can't afford to lose principal. There are a lot of different ways that we can protect. There are ways to shift that interest rate risk from themselves onto a financial company. There's ways to avoid this interest rate risk. And some of you might be saying, why do I need to avoid interest rate risk? Isn't the Federal Reserve going to lower interest rates? And yes, they are talking about lowering rates in the next meeting. We expect a rate cut. However, everyone is expecting a rate cut. And what happens if we get a rate cut and inflation spikes back up? What happens if they need to raise rates again in the future? This is a huge problem for retirees. You need to understand that when interest rates go up, you can lose principal on a lot of investments. And so many people's 401ks, so many of our clients' retirement assets, when they come in, have this huge potential for interest rate risk. Now, risk number 2 is a huge one. It's inflation risk. This is a huge concern, especially with the government deficits that are being run. You're seeing inflation, and it's important you understand that inflation and rising prices are 2 separate things. Inflation is an increase in the money supply that results in higher prices. Well, we already know that we're seeing inflation because the government is running these large deficits. We're seeing increases in the money supply. We're seeing increases in credit. We're seeing credit card balances at all-time highs. So we are in a position where we're seeing the inflation, the rising prices will be there. And one of the biggest mistakes that you can make is hyper-focused on stock market risk. Maybe you decide to get a lower return on your money. You're only going to get 3 or 4%. If inflation is at 5%, you are guaranteed to lose money. You need to diversify your portfolio to make sure that you are keeping up with inflation and exceeding inflation. You need to diversify your investments so you have some investments that can go up with inflation. What does well in an inflationary environment? Energy, agriculture. These are also some of the things that do well in a recessionary environment. So you're protecting yourself from stock market risk at the same time as inflation risk. And so understand this, in a recession, people need to eat. They need to put gas in their car, but they don't need to upgrade to the iPhone 16. So if you focus in on the things that people need, not necessarily the things they want, you will help protect yourself from the inflation risk. Now, the third risk that we really have to look at, that's a risk that a lot of people don't look at, is tax risk. The amount of taxes you're going to have to pay in retirement. Oftentimes you'll Google, what are the biggest expenses for retirees in retirement? And it'll be housing costs or medical costs or insurance costs or grocery bills. Those are not the highest risk. The biggest risk, the biggest expense that we see in retirement is taxes. In fact, a huge amount of people's income goes to taxes in retirement. obviously depending on where your income brackets fall, but this is a big deal. We want to focus in on taxes and understanding the different types of income and how it is taxed. Understanding that Social Security, you pay less federal tax than you do on IRAs and pensions. You may pay no state of income tax, like here in California, no income tax at all on Social Security income. It is more valuable than income from IRAs and 401ks. And you also have a special type of retirement account called a Roth IRA, which is 100% tax-free. This is a fantastic account. So how do we get more money in a Roth IRA? Even if you're not working, oftentimes you can get money into a Roth IRA by converting money from your current IRAs, 401ks, 403bs, TSBs to a Roth IRA. We are experts at doing this, and this is something you should go see a financial advisor. If you don't want to see us, go see a financial advisor that can help you do Roth conversion. Those accounts are tax-free in retirement. Finally, the fourth risk that retirees fail to see is the geopolitical risk. When you look at your portfolio, you really want to focus in on what are the potential geopolitical risks that are in our portfolio. For example, let's say that there's a country in the world that has a high probability they may invade another country in the world. That is a very high geopolitical risk. We may not have those same geopolitical risks in North America, but you see these around the world, in the Middle East, in Asia. There's places that we have to worry about, wars breaking out. And so you want to be in countries that have lower geopolitical risks. And even better, if there's a Cold War going on between two major superpowers in the world, you probably want to be invested in a country that is neutral and selling to both sides of the war. Or maybe they're taking in commodities like oil from one country and they're turning around and saying it's now our oil and selling it out to other countries. You also want to focus in on countries that have young labor force, that have a lot of commodities. And so when you think about geopolitical risk, just ask yourself, what is the risk I'm taking investing in these various places? Now, you might say, I just want to invest in my own country and not worry about the rest of the world. Well, you are taking on another risk, which is the currency risk in your country. And if the currency in your country is dropping, that is a geopolitical risk. You want to make sure you're diversified. Outside of that, you want to have exposure to other currencies and other markets around the world, but you want to make sure you're looking at geopolitical risk because it is a serious risk that can seriously affect your portfolio. So let's recap. We want to not just focus in and hyper-focus on stock market risk. It's very important, and we want to definitely take that into account, but we also want to look at the other risks that you might face in retirement, like the interest rate risk, like the inflation risk, like the risk of taxes, and the geopolitical risk. I'm Matthew Copley, President and CEO of Copley Financial Group, and if you want to know how we help our clients maximize their income and minimize their taxes, just give us a call or visit our website.